Yes.
Good morning, students. In today's session on the live virtual classes conducted by Board of Studies Academics, I, CA Ashish Gupta, Joint Director Board of Studies, welcomes you all. Now, today's topic is risk management in the paper Advanced Financial Management, that is paper number 2, final level. So, student, we have slightly started this topic in our earlier class. Okay, of course, we shall continue in today's class. And in today's class, in a first half, we will cover the theoretical aspect of this chapter, that is risk management, chapter number 2. And then we shall take up the assignment. And I think assignments have been uploaded, maybe. I think I have shared the assignment with almost all students whosoever requested me. So I have shared the assignment in advance, so you can refer the same from there. Otherwise, these questions are from past examination, so you won't face any problem. So student, let us start with the topic of risk management. Now, student, as we were discussing in our last class, second. As we were discussing in our last class, now in today's time, risk management has been become a forte for the CFO also, because now the role has been extended. Okay. Now, when we talk about the risk, so and even we can say that the role of risk has been so increased that even World Bank in their report, or in Bank of International Settlement, in also their report, they are shifting from capital adequacy to the risk adequacy norms as well. So now, because since risk importance has been increased, so risk is of course a financial CFO is concerned, more concerned with the financial risk, but mostly all the risk ultimately results into the financial loss, and that's why they are ultimately financial risk become more important. Now, when we have in the last class, we have identified some risk. Okay, the like strategic risk, compliance risk, operational risk, and financial risk. And I remember that we have covered the strategic risk. Okay, now when we talk about the strategic risk, as I told you, generally these are the risks that ultimately it is a risk related to the what strategy a organization has to adopt. Now, if it goes into it goes wrong, then ultimately the business is going to finish. Okay, it may lead to the bankruptcy. And there are many cases like because sometimes what happens, a poor forevision or poor foresightedness by the top management ultimately result of this risk. Now I have taken, you remember that I have discussed the example of this very good example of the Kodak, okay, where the Kodak and Nokia, there are two examples were there, okay. Now in that case, what happened? Their competitors, like in case of a Kodak, their competitors like Nikon, okay, Canon, these companies have been flourished during this time. Okay, because they have identified, as I told you in the last class, although the digital photography has been invented by this Kodak, but ultimately their competitor like Nikon and Canon has taken the advantage of same. Now in today's time, whenever we talk about any DSLR camera, okay, so there generally the popular names are Canon. Okay, even Nikon may be there, but these two names brands are leading in the DSLR camera type. So generally, professional photographers are using this type of camera. So now it has because of this for lack of foresightness, Kodak has led to the bankruptcy. So because what happens, it is a technological reality that any management has to see. Similarly, we can say the Nokia, Motorola, Samsung, and other companies are as well there. Even me, and even because Oppo, many companies are there now. Similarly, identification type of risk. So ultimately, what happened? Xerox has identified the opportunity and they have come out, because I told you in the last class that Xerox has replaced the LaserJet has replaced the dot matrix printer. Now, there is another type of risk. Today I am discussing the compliance risk. Okay. And what is, see, compliance is generally what happens. Compliance generally impact the have a severe financial impact. Okay, and not only that, sometime even they may lead to reputational damage. Because what you see, there is always a saying that there is a comfort in a non-compliance. Okay, because compliance always incurs cost as well as time. But compliance, sometime what we ignore. So, for example, I give you a very simple example. Now, 31st July 2026 is the last date of filing for the salaried employees or whose accounts are not audited, are required to be audited. They have to file return there by 31st July 2026. Now, once we cross this, does not file the return, okay, it is a kind of a compliance risk I am taking. So what I have to pay? I have to pay the penalty. Okay, I have to pay the interest on the tax due. So all these are toward this penalty. Ultimately, it leads to financial impact. Okay, now what can be reputational damage? Say if I don't file the return even 31st March 2027. So I may receive a notice from the income tax department. It is somewhat kind of a not a good, it is not in a good taste where that is where I'm getting a notice of income tax office because income tax office. See, if anyone we have get any compliance notice from any regulatory authority, it is not a good sign. Okay, it means that we are lacking on our it is there is a lacking on our part to comply with our duties. So it ultimately uh, generally statutory or regulatory requirements are there, then we an organization fails, then ultimately it leads to the compliance risk. Now, when we say that identification of type of risk, this is a cascade regulatory burden. When we say regulatory burden, so regulatory burden generally what happens? It generally increases with the level of the organization. For example, if we have, because it is very important that whenever you are in a type of a organization where the compliances are more, then your duty of complying the becomes heavier. So now it is in the, you can see from the chart this, in a case of a proprietor, generally these are small requirements may be there. Okay, in case of exporter, then RBI and yeah, this is requirement are there. Prevention of Money Laundering Act are there. Okay, and even sometime FCRA regulations may be there, but generally these are generally in case of NGOs. Okay, now then we move to partnership. Okay, LLP. Okay, then here the requirement of LLP Act, etc. These are requirement need to be fulfilled. Okay, so as we have increased it there, then it has our requirement have been increased. Then when we move to the private limited, okay, corporate oversight begins. Okay, here the ROC annual return, etc. begin. I still remember the very we can say it is a kind of an incident happened with me because sometime I remember that it was way around somewhere around 20 years back, maybe more than 20 years back. So actually we were a group of three friends. Okay, of course, two of friend are become a chartered accountant, but one of friend has gone into the business. Now, of course, he has a good knowledge of accounting and ROC, not ROC, basically have a knowledge of accounting, etc. So he told me, uh, he approached to me and my friend told, and he said, ki, I want to form a private limited company. Ultimately, he was running some kind of a partnership business. Good business was there. So he said, ki, to meet some tendering requirement, I need to form a private limited company. So I was quite, he said, ki, just you give me, guide me, and whatever with the procedure further, I will follow the same. I don't want to pay any amount to any other chartered accountant. So I show my reluctance. Okay, so I discussed the same matter with my other friend. So I told him कि भाई he was saying like this. He said, yeah, he was also asking me. So मैंने कहा, what is your opinion? Yeah, he said, I also shown my reluctance. So both of us have a same view. When we start discussing, we came to know because he was asking for getting his business converted into private limited only because for one tender only. To fill up the one tender. So both of us have a same opinion. Once you enter into the arena of ROC or you can say boundaries of the ROC, then filing of the return ROC, then other formalities will be multiplied. Ultimately, we didn't. He ultimately hired some CA, etc. After I think 1 or 2 year, he we met together, three of us. Then he said to me, "Yeah, I made a blunder. What blunder? Kada, I have formed a company, but now every year I am filing the return. Now it has become even I didn't got the tender didn't gone in my favor, and now my liability has increased. So that's why when a company is formed, okay, so regulatory plethora of regulatory requirement comes in pounds on our head. Okay, now when we goes to the public IPO, then our regulatory requirements increase more multifold, because here the public money is involved. Okay, when public money is involved, so of course SEBI is there for the investors protection, and when they are there, then we have to meet the SEBI requirement, LODR requirement. Okay, all these requirement has to be compliant with, and that's why generally as a level of increase and in most of the public limited companies, there are a compliance officer requirement is there, which are generally company secretaries are appointed for the same, because they have to meet the company's requirements. So company secretaries, so all the secretarial work related to the companies are compliant with by the company secretary. So when we see that all the this is a regulatory burden is going on increase. So once it is going to increase, so it means ultimately we have to comply with the this all requirements, and if we don't comply with these regulatory requirements, ultimately we have to come pay the penalty, and it can lead to also the reputational damage. Sometimes even these are you may have listened in the news that the CEO of any particular company or MD of a particular company have been arrested in money laundering case. So all these ultimately leads to the loss of the public confidence and loss of reputation. And ultimately, reputation is a very important in a business, because ultimately it leads to the growth of the business. Reputation is the main one of the very important pillar. Then we come to the next risk, operational risk. Okay, when we talk about the operational risk, so sometimes it is something in the friction in the machine. Okay, when we say the friction in the machine can be an human pupil or it can be a process. Okay, when human element fails due to lack of diligence, human error, or outrightly dishonesty. Three causes generally are there: diligence, lack of you can say lack of attention, or the carelessness. Okay, sometime human error, although the person is doing the work diligently, but still there is chances that human error is possible, or outright dishonesty. Sometimes deliberately a human mind can act according to the for the dishonesty. Then there is a process. Okay, sometimes what happens when internal system, technology, or security protocols break down or are compromised by the external forces. Sometimes, generally, what happens, internal controls or internal systems are threat, or you can say they are breakdown, or even sometimes they are attacked. Nowadays, very common attack or when we process is cyber risk. Okay, nowadays the one of the very leading example of the operation is the cyber, because in earlier time there was no net connectivity was there. So generally any internal system working was totally generally independent, and unless and until there is like any fire breakout, electricity breakdown, all these were used to be a major cause of operational risk. But nowadays, since with the invention of the internet, or with the coming of the internet, the cyber risk has become one of the very important problem. Now even recently, if we talk about the cases, I think it is in Tata Jaguar, I think Tata Jaguar, there also system hacked down, hacked by the cyber hackers, and ultimately it had happened that their production line, I think, affected for a 2 to 3 weeks. Okay, so even and one of the very important example aims that we have discussed. So these are all examples of the process risk where the human failure, human had deliberately have entered into the system and they have break down the system. Now, when we talk about the anatomy of the operational failure, so one of the very leading cases, barring bank case is always a leading example, and somewhat it happened case in 1995 because of course the fraud was going on. I think from 93 to 93 to 94, the complete 1 year, or about 92 to 94, the fraud was going on there, but the ultimately it came to into the picture somewhere in 1995. Okay, and after that, operational risk has become one of the important pillar for the Basel. Basel, there is a guideline for the Basel requirements are there for the banking business. Okay, so Basel guidelines has given the importance to the operational risk, and I think after that the Basel guideline, Basel two guidelines have been implemented where the operational risk has become one of the important pillar. Okay, so this is one of the very leading case, Nicholson. In this, as I told you, maybe in the last class, he has taken the unauthorized position in derivative market. Okay, and ultimately because he has speculated on the Nikkei index that is in Japan based, but due to the I think in 1995 there was a massive earthquake in I think Kyoto. Kyoto, there was a massive earthquake, and due to which the Nikkei has collapsed. So he was speculation on the rise on the Nikkei indexes. So ultimately, it leads to failure of the barring bank that is as used to be called Queen's Bank. Okay, similarly, AIMS Delhi server attack. Okay, this was one of the very important recent. I think 2 years back, it was a very a leading example of the operational risk where the cyber hackers has hacked the system, and even recently because it is cyber hacking is a very important now common days. Now, similarly, barring bank case. Okay, severe process and oversight failure because here, whenever we say the banking bearing bank case, here one of the main cause of the this risk was oversight failure by the top management. Even in this case happened, what happened? The auditor have been sent to this barring bank, but somehow they were not provided proper cooperation from this Nick Leeson, due to which they could not find out the fraud. Okay, then IAMS, I have process breakdown. Then Bhopal gas tragedy, as I one of the told you, this is a major risk. Fat finger trade, wrong error, and then Microsoft blue screen. Okay, so this is one of the example where the cyber attack has, or we can say operational risk are there. And ultimately, when we talk about the risk, ultimately, what we say that people mitigating the say, for example, 10,000 punched as 1 lakh. So it is a keystroke error. Okay, so why now? What happens? People can be commit a mistake. Okay, okay, but how we can mitigate this? We can put a electronic flag. We can put a electronic flag. Okay, system automatically catch the unusual amount. Okay, so we shall see later on. There is a concept of value at risk that will be also a part of our discussion. Just wait for some time. Okay, where uh, we can see that their limit are fixed, or okay, and some amount are fixed. I give you a very good example for the same. Now, student, nowadays, since the computer is everywhere, so whenever you pass any entry, like in system, proposal system or tally, because I have never worked more than except after tally, but I have not worked for any other software. But I remember that when I first started working in the tally, I was very happy because I remember that in our when we used to when we, in our college our CA days when we were doing the CA, and after doing the CA, there was system of manual bookkeeping. Okay, and this because of this manual bookkeeping, the topic of error rectification in 11th class of accounting was of very prime importance. Why it was very importance? Because what happens, I just tell you now. When we have to pass the entry, always what we have to pass the entry, say I am paying a cash to any supplier, Mr. Ram. So I have to make the entry Ram debit to cash account 1000 rupees. However, instead of Ram, I pass the entry Shri Ram. This is another my vendor, this is my another supplier, to cash account. Okay, so now this type of an error generally very common and sometimes it takes place, but this error cannot be catch up in the manual as well as in our electronic system. However, if I am suppose I am Ram, I owe a sum of 1000 to Mr. Ram. Okay, and I have to make the payment. Now instead of making this entry, I am making the payment Ram debit 10,000 to cash account. So the moment I enter the amount 10,000, my system give me alert that Mr. Ram owes a sum of rupees only 1,000. Okay, in that case, there will be a red flag. So now with this computer system, then there is an improvement where generally we used to commit the error in manual system. So now this error can be reduced. So similarly, some inbuilt system can be placed where the limit can be fixed. And even I just give you a very small another example. Now generally there is a, whenever we are using debit card, credit card, there is a control system are there. Okay, where you manage the your card limits, etc. So to avoid the same all the mistakes, you can put a control limit. Okay, because sometimes it may be possible that instead of 10,000 we may enter the 1 lakh amount. So by this putting a control limit in your card, you can fix up the limit or so that it cannot does not exceed. Now there is another type of risk, very important risk, and that is the theme of you can say it is one of the our important is this is a financial risk. Okay, so financial risk are basically exposure to volatility. Okay, so unexpected changes in macroeconomic conditions. Generally, these are macroeconomic. These are beyond our control. Okay, these conditions are beyond our control. We have to manage ourselves. We cannot manage the economic conditions. Okay, now the what is the impact of these factors? Okay, conditions impact are generally external forces multiply directly, altering the value of companies holding investment or increasing the cost of or the liabilities. Ultimately, they may lead to loss or even sometime gain. But one time, what happens? Sometime uh, altering the value of investment means generally it happens in case of a foreign investment. So you can see that this is like a chart. Okay, so our holdings generally what happens? It is going like this. Even due to crash, our holding maybe go like this, spike. All are examples of the financial risk. Okay, this can lead to our investment, or this can be our foreign exchange. This is generally financial risk are generally, as I told you, generally for like here are three important, and I will see the commodity, currency, stock. Okay, stock, commodity, currency, and interest rate risk. These are four categories of the financial products. Okay, or we can say financial elements where these type of risk are more common and there we have to cope up with it. Now, when we talk about the identification of type of risk, and there are five pillars of the financial risk. One of the important is the counterparty risk. Okay, when we talk about the counterparty risk, what is this counterparty risk? I will discuss in detail. But here are first, let us discuss what are our this is our counterparty risk, then political risk. Okay, then there is interest rate risk, currency risk, and liquidity risk. Of course, uh, commodity and prices are commodity and stock are there, but generally these are more considered to be important because interest rate generally affects a lot, and currency risk also affects a lot. And of course, and one more important, commodity risk generally important in case of a manufacturing company, whereas interest rate risk are more important in case of a bank, which are the backbone of the an economy. So that's why their importance is the interest rate risk is for the economy as a whole or for a bank as a whole. And then currency risk is generally every almost even any company is a service oriented company or they are manufacturing company, importer and exporter. So like for Indian Oil, Hindustan Petroleum, so all these companies are basically they are petroleum company and ultimately they are importing the oil. For them, the currency risk is of very prime importance. Okay, because they ultimately oil companies for currency risk is one of the very important risks. Importer exporter. So generally, if it may, they are like even we can say give the example of Infosys because their softwares generally their maximum products are services are going outside India. TCS, HCL. Okay, liquidity risk generally in case of a bank is important again. So we can see that financial risk is very important in case of a bank. Now, when we talk about the political risk, of course, it is not directly related to any financial of the company or any organization, but ultimately political risk results into the financial losses. So that's why generally it is one considered as a one of the pillar of the financial risk. Okay, now when we talk about the counterparty risk, what is this counterparty risk? Generally, these are counterparty risk is generally common in the retailer business. Remember, and even it is very common for the struggling chartered accountant. I'm just on a lighter side. I'm just quoting it. Sometime whenever any new chartered accountant come into the practice, the as per my opinion, the collection of fees has become very challenging for them. Okay, generally the client have a tendency to avoid the say, okay, you take the fees tomorrow in our northern side they say, अरे यार चलता है कल ले लेना परसों ले लेना like this, all these they are use this you can say wordings etc by the client. So what happens ultimately it leads to the counterparty risk. So and even in case of a regular business where the goods have been sold on credit, so credit, ultimately collection of credit is a very important aspect. And that's why there is one topic in your risk receivable management. Why this receivable management topic are studied? Because here the counterparty risk is very important. The more and more period for which the credit is given, the higher the chances of the bad debts are there. So it is some what we can say very commonly term use bad debt. Okay, the debtor has not paid the money. Okay, this may be due to any reason. It may be insolvency. Okay, it may be dishonest intention, diligently, or any dispute. Sometime there may be some dispute may arise due to quality of or the supply terms, etc. So there can be any reason due to which the company is making a failure to pay the deliver the goods or the uh, and even it may goes other way also. Okay, even this way goes other also. If you have made the payment but goods have been not to supply to you, this is also a counterparty risk. Okay, failure to, and more important, it is in the case of a bank or in the case of any business lending business, repay the borrowing and interest, that is called credit risk. Okay, that is called credit risk. Okay, when any it is also called credit risk, and generally when it is in connection with any retail selling, we can say any business of the selling goods and services, and not so it is called generally counterparty risk. But if it is in relation to any failure to repay the borrowing or interest amount or both, then it is called credit risk, and generally this is more present in case of a banking business. So this is one of the important example of the credit risk where or counterparty risk where the does not pay. Like you must have heard, you must have maybe you came to know that like there is one industrialist who have borrowed the money and didn't repay the money, then fled to the outside India. So these are very common. So this is called of a counterparty risk. The bank though who has given the money to them have been remained unpaid. Okay, so this is called counterparty risk. Now, next is political risk. When we talk about the political risk, ultimately, this kind of a risk, of course, does not have any direct impact, but it is why it is, and what are we can say that what is the checklist? Confiscation or the destruction of the overseas properties. And generally, what happens? There are some, we can say, what are the type of a political risk are there? Confiscation of the goods or properties by the foreign country, meaning that they does what they do, they we can say that they ultimately acquire the property without any proper compensation. Okay, they acquire the property without any proper compensation, and this has or even what happens, you may have a company may have a installed a project, they may have a installed a project, but ultimately the without government has acquired the same without making adequate compensation. Okay, so and this is a very recent. There is one example I give you is a very good example. Somewhere around in 2010, okay, the government there is a company. If you have heard the name, that is GMR. एसी एसी कितने है ना सर कितने 22 है कितने बस फैन तेज कर देना जरा 30 पे फैन तेज कर दो तो लो पे होगा फैन से और कम कर दो मतलब नहीं फैन ऑन है उसका खाली है फैन अच्छा है ठीक है. Okay, there is a company GMR. Okay, in 2010, the GMR has entered into the with we can say an agreement with the government of Maldives. Okay, okay, government of Maldives and Maldives International Airport Company. Okay, MA Maldives Airport International International Airport, yeah, my company limited. It was a company limited. So they have entered into agreement for the modernization of Maldives Airport, International Airport. The modernization agreement has been entered with it. Okay. So at that time there was a one government. Okay. Somewhere around in 2002 there was a coup in the Maldives, and the military head has become the president. Okay, once he has become the president, what did he do? The government uh, repudiated the contract. Okay, repudiated the contract, and whatever the investment has been made by GMR there, no compensation has been made to them, and they have alleged that they have bribed the money to the previous government, so that's why we are terminating. And after that, there was a one clause that uh, in case of any dispute, they will be settled by the Singapore or London arbitration court. So of course, GMR has gone into the arbitration proceeding, and ultimately they have won the compensation amount. But ultimately, it was a long legal battle for the company. So this is one of the example where the government has confiscated their all the investment, whatever the investment they have made, there no payment has been made to them, and ultimately so it led to the losses of the to the GMR use. Then rationing of remittance to the home currency. It is one of the very common feature Like I just give you a very simple example how this is risk work. Now say a company, say a PLC, a UK company, invest the money in India. Okay. Invest in India. Okay. Now, what is the purpose of making the investment in India? They want, once they make the profit, okay, so they will like to ram it back this profit to UK. Okay. So when they will like to ram it back to the profit, ultimately they have to make some remittance in the foreign currency. But that means they have to buy they have made the payment in pound here, get converted into rupees, and investment made in rupees. Once they have earned the money rupee back in India, so they will like to get converted into dollar or pound to remit back the money to their country. Now, in this case, if the home country, India, place a restriction on them that you cannot take back the money, then ultimately it is a loss to the APLC. So that's why it is also kind of a risk. Of course, India is not that harsh country, of course, but however, we have placed some restriction, and in this context, there is capital convertibility restriction are there. Capital account convertibility. It is all current account convertibility means any current account transactions are convertible into rupees or dollar, vice versa, or the foreign currency. Then there are current capital account convertibility where you cannot easily convert your capital in India, then you convert back into the foreign currency. So these are the restrictions are there, remittance of the foreign currency. Now there is a restriction on the local to foreign currency conversion, that is the same thing. Then restriction on the borrowing. Okay, they may put a restriction that you cannot borrow money here. Ultimately, they have to borrow from outside India, outside their foreign country at a hefty rate. Okay, then there is a invalidation of the patent. Okay, their patents are infringed. Okay, their patents are not given any protection. Okay, and then it is a price control of the product. They put a price control okay, that you cannot sell the price product more than this price. Ultimately, this company has come into the for the doing the business in any other country to make the profit. But if the restrictions are placed on them, so ultimately they are going to have a losses. So this is the kind of a political risk example are there. Then there is another risk. Financial risk is an interest rate risk. Okay, as a student, it may be known to you there are two type of interest rate. One is fixed interest rate. Another is floating interest rate. Okay, so now here we don't know what will happen in the future. Okay, all the interest rate are driven by market forces. Generally, it happens with the senior citizen. It is very common for them. Say today the rate of interest for them 8.6.85% for particular period. Say the FD is for the say 3 years. Okay, so now say any senior citizen invest a sum of rupee 1 crore with bank for this amount at this rate of interest. So now what happens tomorrow? They say after 1 year, this rate of interest becomes 7.15%. Now this senior citizen will get a will repent because ultimately his investment is at 0.30%. Okay, 0.30%. It means 30 basis point less than the market rate. Okay, so this is due to the change in the fixed rate. Okay, now there is another example. there is a fixed and floating. Generally, whenever we are going for a home loan. Okay, the bank gives us a condition that at what rate of interest you want to peg your loan. Okay, say today my say floating rate generally are, as I told you, these are generally benchmark rate. This can be marginal cost, MCLR. This is okay. This is called marginal cost of lending rate. This is marginal cost, and this is MIBOR, Mumbai Interbank Offer Rate. Okay, and repo rate is generally mostly used by the bankers for settling the loan. Generally, what happens, say in a repo plus, they add some basis points, say 200 basis point, you can borrow the money. Okay, they give us a choice. Okay, either you can go for a fixed bank. I go to the bank and apply for the home loan. Okay, the bank give me the choice. He says, Mr. Gupta, either we give you two options that you can borrow at repo plus 200 basis point. Okay, whatever will be the repo there. And another choice is today you fix up the rate of say 8.5% fixed interest rate. So today, if rate of interest repo is say somewhere around 7%, so I will say I will have to pay 9%, but as per fix, will pay the 8.50. So of course it will come into my mind, yeah, okay, I will go for this rate. But say after 6 months, repo rate falls down to 6.25%. Of course, had I been entered into the floating rate agreement, then my interest burden would have been 8.25%. So ultimately, a loss of 0.25% I am incurring. So that's why if it says a company borrows floating, an increase in the raise in the liability, but because if it rise, it raising up, but if the floating rate falls, a fixed rate liability becomes comparatively heavier to pay, as it case in my case. Okay, now say tomorrow this rate of interest repo has become 7.5. So ultimately, what will happen? I have taken the loan on repo rate, so my liability will become 9.50. Had I been taken then in that case, I may repent that why I have not taken the loan at 8.5. So it depends on in what, so it is always we have to take a risk. Okay, it is always we have to take the risk. So this is one of the important risk, that is interest rate risk, one of the important risk of the pillar of the financial risk. Now then it comes the currency risk. Okay, currency risk is a kind of a seesaw. Okay, if the Indian rupee depreciate. Now, student, before we proceed further, let us discuss the term what is depreciation and what is appreciation of a currency. Say today, $1 rate is equivalent to 96 rupees. Okay, that is say with today's rate. Okay, we can say it is a T0 rate. Say after next day, this rate become 97. Okay, so it means rupee depreciation, dollar appreciation. On the other hand, I take this condition I take a different color. Okay. Now I case another case. Say if on T1 $1 becomes rupees 95. Okay, so it will be called rupee appreciation. Okay, and dollar depreciation. Okay, there is another term is used here. It is called rupee becomes stronger and dollar has become weaker. This is another term. Similarly, here rupee has become weaker and here is become has stronger. Is that clear? So it means, say now see what happens in case of exporter. They have got a benefit when the dollar appreciate. Okay, say I give you an example. Now say Infosys company has entered into an agreement, okay, where they have raised a bill of or invoice, say $1 lakh to any particular company, say ANC Incorporation in USA. Okay, they have raised the bill on say 20, say 4th December 25. Okay, at that time, the dollar rate was, say, dollar was somewhere around 92. Okay, accordingly, what they have thought, and this remittance is likely to be received somewhere around 23 after 3 months, 23, 23rd March 26. Okay, now at this moment of time, the rate was somewhere around this. Now, say by the remittance, they have received the money. Okay, at that time, the dollar has become stronger and has become this. So ultimately, dollar has become stronger and rupee has weaker. So earlier they have thought that they will receive 92 lakh rupees once the foreign, because see what happens whenever any foreign exchange comes into the India, except some conditions are met, they have to get converted automatically into the Indian currency. Okay, now the time moment they receive the money, this money has become strong. Rupee has become weaker and dollar has become stronger. So this they have converted the money, so they will get a benefit, straight benefit of rupees 2 lakh on a one contract of invoice of 1 lakh. So that's why what happens whenever any our Indian rupees are becoming weaker, the balance sheet of this type of a companies shows a profit. Okay, and this is another called a non-operating gain. Are you getting it? It is clear. And since you are a students of the accountancy as well financial reporting, so you may know the adjustment what how we have carry out the adjustment. On the other hand, when we talk about the an Indian oil, they are the importer. Okay, so same day, same way on a 24th, and just take a different color. On a 24th December, they have a import bill of say $1 million. Okay, they have to make the payment after 3 months, and at the same rate, they have planned that ultimately this much amount they have to pay. Suppose ultimately if we use this rate and ultimately dollar rate has become stronger, so by the time they have made the payment, this much of extra amount they have to incur. So this is a loss to them and this is gain to them. So we can say that key takeaway is currency risk is entirely is a directional, okay, and it depends on the flow of transactions, the flow, cash flow direction, in which direction you are going. So this way, other way can also be go there. If the rupee has become stronger, then this CISA will be gone down and this will go up. Okay, so this is also happen. Okay, student. So now next risk is the liquidity risk. Okay, it is also called the liquidity risk. It is also called the maturity mismatch. Now, when we talk about the liquidity risk, student, I take back to you to your classes of the FM. Okay, where the topic you must have referred. Cash budgeting. Student, today I know that your Zoom working is not working. This will work in the last 15 minutes. But I think from the next class, we will have a direct interaction with you. So, but had we have an interaction, so I would have asked you what was the purpose of the cash budgeting preparation. See, whether I have told you, it is we can say that whatever the concept we have discussed at our inter level, they were generally frequently not directly used. They are generally used in reference to some other concept. Now, what was the purpose of this cash budgeting? If you recall that. Generally, the cash purpose of the cash budgeting was twofold. Okay, once to invest surplus money if it is left for the profit. Okay, and because if we are keeping the surplus money in our with us, okay, ultimately we are having a opportunity loss. Okay, now other was to meet deficit. Okay, if there is any minus figure is there, then it is a point of concern over there, because we have to keep our cash ready at this moment. Because what happens, because due to this liquidity risk, even an organization can fail. And very good example is bank rush. Bank rush primarily result into the liquidity risk. What we mean by the bank rush? Are you aware about this term, bank rush? Bank rush means when all the depositors moves to the bank to get withdraw their money. Okay, and generally this happen in case of any rumor, okay, or there any apprehension when the bank is going to fail, because generally whenever bank's financial position become weaker, so there are restrictions are placed by the RBI or any regulatory body, so that you cannot withdraw the complete money. They put some restriction on limited money. So there was I think recently, I think 4 to 5 years, there was a cooperative bank in Maharashtra, okay, where this case has happened. Okay, the money has, their restriction have been put on them to withdraw the money. So uh, this was a case. Okay, so in this case, they cannot withdraw the money. Okay, I think it was somewhere Lakshmi, and if I'm not wrong, Lakshmi Vilas Bank. It was somewhere. I'm not sure about the name. It was someone name like this. So here the money has been put by the investor, depositor could not be withdrawn. So this is a kind of a liquidity risk. Or generally, in case of a bank, this risk is also very important. Not for the bank rush also. This liquidity risk also very important. One, I just give you an example. Whenever sometime what happens uh, in some branches of the bank, if you go there and you would want to withdraw your hefty amount of money for your any whatever the reason, so sometime bank may have a cash, but sometime they don't have the cash. So in that case, what they do, they will try to arrange the cash from their any other branches. Okay, if the other branches have a cash, then not a problem. The cash will be transported and it will be given to handed over to you. But even the other branch may not have it, then they may approach to the regional office. Okay, so like this, there is a so this liquidity, and sometimes this liquidity mismatch becomes so much heavier that it cannot be solved at a regional level. So then it becomes to the head office level. So this liquidity mismatch or liability mismatch or asset liability mismatch is a very important case of a bank. And sometimes it also saying very important. Now, so suppose some investor have deposited the money, say of rupees 1 crore in a bank. Okay, for 3-year FD. Okay, and this 1 crore bank has lended the money to some lender at say for the same 3 or 2 year 50 360 300 days to any lender, to any borrower. Okay, so ultimately what the bank generally does, they give the same money to the at the interest paid to the investor at 6.5, they charge it from the 7.75 or somewhat amount. So this spread of 1.25 is ultimately the bank income. Now if this depositor does not turn up to get back his money up to the 3 year, there is not an issue. The moment problem liquidity risk may come when they approach the bank to get back his money before this period. Okay, so then it becomes a liquidity risk. Okay, generally this risk can be controlled by seasonal analysis. Seasonal, we can say that we may analyze what are our seasonal requirements. Generally, like in case of a woolen business, the requirements of a fund more are in case of winter are there, because that at the time the woolen clothes are manufactured, and in during the winter time, summer time, sorry, clothes are manufactured, and in the winter time there is a sale. So by this it can be foreseen. And so we can say that it arises from a concluding remark, from an inability to generate adequate cash, or the mismatch between the maturities of the outgoing payment and the patterns of receiver fresh deposit. So I hope it is clear to you, risk ma'am. Now, in the last, if we have to differentiate between the operational risk and the financial risk, so what is the criteria? What is the criteria? So these are generally the differences are there, like operational risk are internal, external risk. These are financial risk are external. Okay, these are employee based. These are rates, prices, credit, and political policies. These are error. Okay, these are devaluation, illiquidity, and counterparty defaults. Human checkers are there if we want to mitigate them, or electronic system flag. Okay, red flag system are there. Hedging is very important, because hedging are the basis of our chapter number 9, 10 and 12. These three chapters are based for the on a hedging. Okay, rate matching, and generally it is also a part of hedging, but rarely it happens. But sometimes it may be used. Then geographical diversification, and for geographical diversification we can say that it is a chapter number 11, where we cross border capital budgeting. When we cross the border, because we don't want to take the risk in our own country's economy. Okay, this is the now this slide is important. Ultimately, we can say that this is the slide risk cascade effect. Okay, operational failure can trigger the compliance risk, then it can reduce to financial risk, and ultimately it restrict our strategic option because we have to consider it as a long term. So ultimately, we can say that risk is cannot be discussed in a silo approach, and it is the basis of the enterprise risk management. Enterprise risk management says the risk cannot be operated in a silos. Okay, they have to be overall integrated approach we have to follow. We have to see over an organization basis. Now, when we talk about the evaluation of the financial risk, okay, how the financial risk is viewed by the different stakeholders. So generally, when we talk about the different stakeholders, one of the very important stakeholder is equity. Equity are the provider of the funds and they take the risk. They take the risk. One second. Equity. Okay, so equity are the taker of the risk and ultimately. So now what is there from their perspective, from their viewpoint? Generally, they considered the financial leverage or financial gearing. It means borrowing debt is a high risk to them because during liquidation, ultimately the debt will be paid first. Their number will come in the last. So, but we have to see, we have to maintain a balance because as per the financial leverage, it has a way, it impacts our earning per share. If our rate of return on investment is greater than our cost of debt, then of course, but we have to see also that excessive borrowing can also lead to the loss because as I told you, the financial leverage is a two-sided edge. Okay, double side, we can say generally double side, double edged sword. Then from company's perspective, liquidation is one of their main risk. If the excessive borrowing is there, then financial risk is there from them. The lender sensitivity, default on the interest rate pays or the principal. If any lender is giving the money to the company, so from their perspective, the financial risk is their money. Okay, so we can see that everyone have stakeholder have their different views, their different interests. Similarly, when we talk about from the government point of view, okay, government point of view, generally they say if the any banking system fails out, so they have to declare a bailout package. It is also lost to the government because ultimately what the bank does, bank has to not bank, government has to ensure that the bank should not fail because once the bank is failed, the overall we can say financial system economy comes into the danger. So generally they come out with the bail packages, etc. And even sometime the sovereign debt or willful defaulter has also it can be extended. So from macro perspective, and there is very famous Greek Greece default is somewhere around in 2008. The government of Greece has defaulted on the repayment of their treasury bonds. Okay, because see what happens if Indian treasury bonds are there, these money is borrowed by the government. Okay, treasury bonds generally are the issued by the government. These are issued by them Okay, and they ultimately repay the interest along with the principal. But once the government refuses to pay the money, it is called sovereign debt crisis. So somewhere around in, I think it was in 2008 or 9, but it is a very famous case where the Greek government has defaulted on their bonds. So ultimately, this we can say that different stakeholders have a different perspective. Now we are coming to the very important topic, value at risk. Okay, it is one of the practical topic as well as, and we can say that it is somewhat kind of a playbook. Okay, we can say it is a very playbook, and it is highly prevalent in the use in the banking and institutional investment companies. And very important, there is a very on the this top valuation, this value at risk concept. There is a I think this money and this feature film is on in the OTT platform Margin Call. Okay, there is a movie called Margin Call where this movie is based on this value at risk. Okay, so where value at risk means, now what is the answer? It answer basically two questions. What question it answer? What is the worst case scenario in financial world? Okay, what will be the, and what will be the expected loss? What will be the expected loss? Okay, somewhere it was applied first in 1922 in New York Stock Exchange. Okay, then it was applied by financial institution in somewhere in 1990. I think it was JP Morgan. Okay, it was JP Morgan that it has applied the first, that how much investment is like a amount of loss they are likely to incur on some portfolio. Okay, so it is very important to note that it does not minimize the risk. Okay, it is a kind of a risk measurement technique. It used to gauge whether the portfolio's potential loss align with the institutional maximum risk appetite. Now, what is the term of risk appetite? Risk appetite means the capacity, okay, capacity as well as we can say it is a desire. Okay, it is a desire, or the we can say it is a kind of a level at up to which we can bear the risk. Now, for the student perspective, any every student has their own risk appetite. Some student says I will take the both groups. Okay, they have a high risk appetite. Okay, some will say, okay, I will take only single group. They may have a lower risk appetite. So risk appetite is own perspective, and it also depends on the company's policies. Okay, in case of a companies, any company may have a high risk appetite. They may speculate on any business, but a company may be have a low risk appetite. They don't invest in any speculative business. Like in case of a mutual fund, equity mutual fund investor have a high risk appetite. On the other hand, debt mutual fund where the income is safe, they have a low appetite. Now, if you are buying the share, equity share, you have a high risk appetite. But if you are depositing your money in FD, okay, in any government postal office scheme for a lower interest, fixed interest rate, you want fixed interest rate, fixed. So it is you have a lower risk appetite. So it depends on the maximum loss that you can bear, or whatever the maximum loss possible, keeping in view your risk appetite, it's lets you know. Okay, so now how it works, how it works. So it is a very beautiful example. Now say if that the value of my portfolio is 5 lakh, it's 99% confidence level for 1 day horizon. Okay, say I am holding any portfolio, okay, and I give this statement. So what does this statement mean? Value where means value at risk. Okay, so what does it mean? Ultimately, 99% means 1% probability. There is a 1% probability. The maximum loss, expected loss will exceed rupees 5 lakh only. Okay, that my loss will exceed 5. There is 1% chance is there. There is only 1% chance is there. Okay, so during the span of one single trading day, there is a chances of that my loss will exceed 5%, 5 lakh rupees on my portfolio. So confidence and probability have a opposite relationship. And how it is arrived? 100 minus 99. If I say it is 95, then this become 5. If I say 90, then it becomes 10%. So we can say that where defines the exact threshold of your worst case scenario and on a statically normal bad day. So normal day is very important. Here the term normal is very important because what happens on extraordinary days, the where could be failed. Okay, where could be failed, and generally this happens in case of black swan events. Black swan events are those events that cannot be predicted. Okay, and they rarely happens, but once they happens, their impact is catastrophic. Okay, like COVID has happened after a lot of time. I would say 100 years to 100 years back, the same position has taken place. Like there is a plague in UK, etc. So similar type of situation has rarely occurred. But the impact was that all theories have been failed. Losses were huge. So these are kind of events are black swan events. Any earthquake, tsunami, these are generally black swan events. We cannot be predicted, but whenever they happen, their impact is there very heavy. Okay, so this is generally normal is very important for use where means in normal working day, normal trading day. Now, what are the features? What are the features of where? Okay, these are the components. Okay, what are the components? First of all, time period is very important. We have to consider for how much time we are considering our loss. As I in a previous example, my day was horizon was 1 day. Okay, this can be 1 week, this can be one fortnight, 1 month. Okay, one semi-annual or annual. Okay, it depends on my estimation or my calculations. So next is confidence level. Generally, certainty of prediction. Generally, we want 99% confidence, 95%. So this dictates the generally this is are more related with the tolerance of the or the institutional tolerance, or we can say it is somewhat connected to the risk appetite. Okay. Next is the maximum loss. Maximum loss. It can be in currency or percentage, both. So we can say that like in previous example, I was saying my portfolio's loss at the 5 lakh. So this was in absolute term. But if say my portfolio is of rupees 1 crore, then this will become percent will become 5%. Okay. So rupees 5 lakh or 5%, both are same. It where can be presented in both manner. Now question comes, a very important feature of the where is it can be a key driver. We can say it is kind of a key driver. What are the key drivers of where? One is standard deviation. Okay, standard deviation, return distribution, and basically standard deviation means the return will vary. Generally, what happens if we see that our return is like this, probability like this, so this mean value is there, then this is a deviation. Okay, this is the deviation value. So we can see that how much value deviate from the mean. So see, it is a mean value, but all the values are does not like here. They are like this here, this. So this deviation from the mean is basically standard deviation, and this is one of the, we can say, key driver of this our where. Okay, and very importantly, generally we use the historical standard deviation. Okay, see what happens, we generally we analyze the data of previous years. Okay, on that basis we estimate the standard deviation. So that is called, it is called historical volatility. Okay, historical volatility generally means the standard deviation. On that basis we compute, okay, this much is our standard deviation, and this is our, and how it varies from the standard. So it is one of the key driver. Now it is very important. See, whenever we time horizon we have to change. Like in our earlier example, I was saying that 1 day time horizon. Okay, I want to know how much amount of loss. Okay, where, how much, where will be of my, say, 10 days. Okay, how much where of will be my of 10 days. So how I will compute it? See student, we generally, what happens, it is very important to note, generally these are not linearly related. Time is not linearly related. Okay, because if I multiply, say, if I say my 1 day time horizon where is rupees 5 lakh, I want to compute 10 days. If I multiply 50, it will become 50 lakh. It is very compounded effect. It is a very compounded effect. So we will not accept the same. So what we do, we compute like this, rupees 5 lakh into square root of 10. Okay, and we compute the amount. So somewhere amount comes rupees 15 lakh 81,139 approximate. So this will be my where for the 10 days. So it is always remember that whenever we have to multiply, change, convert into the time horizon, it will be done like this. Okay, and we can also do this reverse also. If this much I say that my where for the 10-day trading day horizon is 15 lakh this, then what will be my 1 day where? So I will do like this. Okay, so this way I can also do the same. Okay, student. So now this is, we come to this feature of the where probability. As I told you, 99% confidence means somewhere it is coming tail risk. It is also called the tail risk, maximum probable loss. So this will be the area. Okay, somewhere this, if we see that now when we have to calculate this area, how we calculate the VAR. So let us see the what is how we calculate the VAR. First of all, this is the portfolio value. Okay, jet score. Jet score, it is a normal variate. Okay, the standard normal variable derived from the desired confidence level exactly 2.33 for the 99. So see here somewhere it is, see here this amount will come here somewhere 2.33. Okay, so 99% confidence level is 2.33 from the mean. The isolated historical volatility of standard deviation that we have to multiply. So see here, standard deviation is, this is standard deviation, and it is here, it is our variable. So according to this variable, the area covered is shown. Okay, the left out area, overall area is this under normal curve is 1. So whatever be the value we get by multiplying this, okay, this multiplying area, this area, we deduct it from the same. So balance is left our VAR. Okay, of course, when we will do the question, then we came to know. Okay, these are the different level of confidence. These are the different level of confidence and jet score. Okay, student. So please memorize these two jet scores, 99, 98, and 95, and even 90. These are mostly used. Okay, so if I want 90% confidence, that is 10% probability, it is 1.65. Okay, and if it is 95, that is 5% probability, it is 1.96. And if it is 98, these are mostly used. These are commonly used. 3.29 is rarely used. Okay, student. Now, when we talk about the VAR application, okay, these are normally used for the front desk trading. It is very important because had these been used and followed in barring bank case, okay, what happens there are, as I told you, there are three kind of office: front desk, middle office, and back office. So for the front office, there is a cap is put. Yeah, you cannot have a VAR more than it. Had this VAR been used in the case of a barring bank case strictly, then bank would not have been failed. Okay, nobody can take a position more than it. Okay, asset liability mismatch. Okay, bank can know that how much my assets are at a risk and how much liability at my how much liabilities at a risk. So they can asset liability management can also be there. Okay, they can note that how much my portfolio loss will be there and how much I have to can pay to the extra, or how much even I can gain from these liabilities. Okay, then performance benchmarking. Okay, sometimes it is also for the team that they came to know how much amount they have put to the risk against the where how much gain they have taken. A comparative sheet can be prepared and performance can be evaluated. Okay, now the strategic position. Okay, so it allows them to take strategic position in the market as per their risk appetite. Any company can say that our where position is this much. This also applies in case of a retail investor as well. Okay, so this is the system. Ultimately, we Now, last part we are coming of this theoretical portion. After that, we will have a break. Now, identification and management of counterparty risk. How we identify, or we can say that it is kind of a red flags. These are kind of a red flags. Okay, that helps to identify the risk. First, failure to obtain the necessary resources to complete the project. Now, the counterparty to whom you have lended the money, they may failure to obtain necessary documents, necessary approvals, resources to complete the project, then your money will be in a problem. Okay, they will say, yeah, I can't do anything. My project could not have been completed. Regulatory restriction imposed by the tomorrow if you have lended the money or you have supplied some goods to any company and the government has put a restriction on further project. Generally, it happens in case of a construction project where in a midway of any construction, the construction is halted due to any reason. They say that this construction is illegal. The Because generally it goes on a credit basis, so money suppliers money got stuck up there. Hostile action originating from this is country risk, or we can say it is a political risk. Let down or non-performance by a third party. Sometimes what happens, any other third party may who has defaulted, okay, it may be defaulted by them. Say you have lent the money to B have lent the money to C defaults. Okay, it may be possible that unless and until there are some insurance clause, credit default swap are there, it will ultimately impact his position. Okay, insolvency of the company itself gone into the become insolvent. So these are some red flags. Then how we can manage this risk? Okay, carry out due diligence before dealing with any third party. See, this is very common in our finance and marketing scenarios. Generally, in marketing, that to meet the target, sometimes the marketing people may sell the products or give the money to the credit to any person from whom the chances are recovery of the list. And that's why this was one of the main reason of the 2000 Lehman Brothers crisis, where the money housing loan has been granted to those person and those borrowers whose the chances of getting back the money were very bleak. Okay, so without any due diligence, the money have been lended to them. Okay, limits. Put a limits on X. This is very important. It is basically it is also avoid the concentration risk. Okay, this is one of the very important portfolio diversification. Don't lend the money to any single investor. Okay, sometimes it also happen in case of a bank. A bank may heavily lend the money to any one industrialist or any one person, and that person is defaulted. The bank will fail. Okay, instead of that, divide the money. Okay, regularly follow the procedure. Credit rating. If the company's credit rating is going down, just take back your money. Take rapid action in case of any likelihood of default. Same. If small default has been taken place, then take your money back. Okay, protect. Use guarantee, insurance, and protective instrument. Generally, credit default swap. That we will discuss in the topic of derivative, where a credit derivative, where a lender takes a credit default swap agreement. In which case, if the borrower defaults, then they get back their money. Then identify what are the red flags for the. These are the red flags. In case of a political risk, when the government says you employ our own labor, restriction on conversion of currency, remittance restriction, expropriation asset, acquisition of asset by the government without an appropriate compensation, and sixth, fixation of price control. So how we can cope up with this? Ranking, we can refer the ranking magazines, evaluation of countries' macroeconomic conditions, okay, analysis of the government popularity and stability, and direct advice by the home country embassies. Generally, they issue the advisories. Sometimes advisories are issued by the different World Bank and other. Okay, identification of management of how we can cope up with this risk. Okay, so we can also directly establish joint ventures with them. Okay, we can we can employ the local resources so that God before before making you run away from the country, the government may think this company is providing the employment to so many labors. Okay, and even it is always preferred that you enter into an agreement, strict agreement with the government. Okay, because tomorrow the government can change and then clauses because of this clause you can save yourself. Then is take the capital from the host country. Okay, ultimately the money will be lost. Money will be of the host country will be lost. Okay, then how we identify the monetary what are the red flags in the interest rate risk? So monetary policy of the government, repo rate, direct action, demonetization, like what are the government action are there? Demonetization was a good example. Overall economic growth transaction, GDP growth. Okay, release of industrial data. Okay, volume of investment, FDI is a good indicator of an interest rate risk because as much as money will flow in there, the interest rate is going to rise because more and more demand of the funds. Volatility in the change in the stock market. Stock market also plays a good role. Okay, so and how we can this then another is uh, currency risk red flags. Okay, red flags are there. Policy and leadership like Brexit. Due to the decision of the government, British government of the Brexit, the pound value has become very low. Okay, it has depreciated, bring it to the level of this. Then there is a concept of interest rate parity that we will discuss when we'll discuss the topic of interest rate yeah, that is current foreign exchange risk exposure and management. Then economic fundamentals, geoclassical, war, coup. It is a far technical impact. Now, if a country where there is a coup like Burma, okay, so in this country, the country's currency is very weak. Okay, their chances of their currency is very weak. Okay, this is okay. So, student, with this, we have come to the closing part of our one more important point. But please note for this currency risk and interest rate risk, we have a separate chapter. Okay, currency risk, where we have a separate chapter we will discuss in the later. Okay, so with this, we come to the end of theoretical portion of risk management. Now, there is a small break I'm taking. It is somewhere around 8:35. So we will reassemble at 8:45. Sanket ji, just put the slide of break. Okay, student, welcome back. Now, in the previous discussion, we have covered up the all the aspect of value at risk. Okay, and generally on which the our numerical questions are based. So this assignment has been supplied to the students who have asked for the same. Of course, this assignment will be uploaded, I think, by today's evening or by tomorrow morning. Okay, anyway, these questions have been adopted from the previous study suggested answer. So this was the first question that I am discussing with you. This question has come into the examination when this scheme, we can say, although it is an old scheme, but this topic was first time introduced somewhere around in 2018. So because it was 2017, the topic of risk management has been incorporated in the syllabus of SFM. Okay, so that time this was the first question on this has been asked. So it says like this: Neil holds a rupees 10 crore share of XY Limited, whose market price standard deviation is 2% per day. Sorry, 1 second. Percent per day. Okay, so this is a standard deviation and this is a time horizon. Assuming 252 trading days in a year. Okay, generally sometime it may also be 250 as well. In some cases, if they have been given a year, determine the maximum loss over a period of 1 trading days, 10 trading days with a 99% confidence level. Assume that share prices are normally distributed. Here we can add normally distributed for level of 99%. The equivalent jet score from the normal table of cumulative area shell is 2.33. Now student, please note that if you see the assignment, in the backside of assignment, this table have been given to you. So basically this is a cumulative area. Okay, please always remember cumulative area is given like this. As I told you, overall area is 99.99 means it is overall area is somewhere around 1. Okay, so the complete area somewhat around is 0.9999. Okay, so what happens? This point is 3.09. So overall, this standard deviation of 3.90 are all on either side, this side or this side. This is a mean value. This side or this side, it covers it. So cumulative area means this area. Okay, sometime you may provide it with the tail area. Okay, now in this case of tail area, it is opposite to the this value. Like here, if we say that tail area will be this. Okay, so for cumulative area, always do 1 minus tail area. It is very important. Even it can be changed in the examination. So please always remember. Okay, it is very important point. Generally, student commit a mistake in this. Okay, and this area also will be used when we shall do the derivative in where with the topic of Black-Scholes model, the same table will be used. So here we can see that for a normal variate of 2.33. Okay, so here we see this, okay, 2.33. 1 second. 1 second. Okay, student. So let us see. Okay, so now let us start solving the question. Assuming share prices are normally distributed, or a level of 99% confidence, the equivalent get score from normal table of cumulative area. Accordingly, now first of all, we calculate the volatility in terms of rupees. So 2% of rupees 10 crore equal to rupees 20 lakhs. अरे अजीत, यहाँ अजीत इधर व्हाइट से कुछ आ गया था, आप उस चला गया, लेकिन यहाँ पे एक व्हाइट से वो आ गया था, पैच से आ गया था, नजर नहीं आ रहा था। ये नहीं, व्हाइट से वैसे कुछ आ गया था। चलो एनीवे, यहाँ पे आके बैठे रहो, मेरे को कुछ देखना पड़ा। Okay, the maximum loss for the 1 day confidence level. So how much loss, maximum loss, because it is the maximum loss one day at 99% confidence level is rupees 20 lakh into 2.33. So it means rupees 46 point lakh. Okay, so it can also be said that there are 1% probability. There is 1% probability the loss would exceed 46.60 lakh in a 1 day. Because that is set on the basis of this volatility factor. Now, the expected maximum loss for 10 trading days shall be, now as you know that we have discussed in the while we were doing the PPT, that it is not exactly that we can say that, we cannot say that like 46 lakh into 10 This is wrong. So what we shall do, 46.60 lakh into square root of 10. Okay, the resultant figure will be okay, students. So this has clear to you. Now accordingly we can say that now we can say that there is a 1% probability that our loss will exceed 147.36 lakh within a span of trading days of 10 trading days. Okay, earlier this figure was 46 this for the single trading day. So this can be interpreted as well as this in this manner. Similarly, if I say when we have to compute for the 95%, okay, 99.5% of confidence level. Okay, only the thing is that I have to change this variable. Okay, I have to change only that variable. Okay, this will give me the information and what will be the applicable this. If I say 90, so for this figure will be applicable will be 1.96 for the 95% confidence level. Per day loss will be okay. And similarly for the 10 trading days, simply we multiply rupees 39.0 lakh so approximate figure will become 123.96 lakh. So we can see that as the level of confidence decreases, okay, so it also decreases, value at risk also decreases because it is dependent on the jet score. And here the probability is will be 5% probability. So the more the probability, lesser will be the value at risk. Okay, student. Now let us move to the next question, and I hope you must have note down the solution. Still, if you want to note it down, please note it down. No problem. I can take 1 minute pause, 30-second pause. So let us student, let us move to another question. Question number second. Please read the question. It says that ABC Limited is considering a project X, which is normally distributed. So it is a one of the important feature and has a mean return of 2 crore with a standard deviation of 1.6 crore. In case ABC Limited loses on any project more than 1 crore, there will be a financial difficulties. Okay, determine the probability that company will be in the financial difficulty. So student, please note here. First, we have to we shall prepare a diagram. Okay, from this diagram, we understand the logic behind this question. Okay, this question says that our mean return from the project is rupees 2 crore. Okay, from the mean project is a 2 crore. So 2 crore is a mean value. We can say it is a mu. Okay, and it will be in the financial difficulty if the losses is a -1 crore. So see, please note that here this side all values will be the increasing towards this side, minus the value will be start decreasing. So here the value start decreasing. Here it may become 0, say. Here somewhat it become the -1 crore. Okay, so basically we have to find this area. So we have a two option. We will find out this area. Okay, we find out this area, cumulative area, and deduct it from the 1. Okay, we find out this area, cumulative area, and deduct it from the 1. Okay, students. So now let us solve the question and see how we can compute the same. Area under normal curve corresponding to the Z score obtained from the following equation. Okay, because see here, we have to first find out this Z score. Okay, so Z score is unknown here. So first of all, we shall calculate the Z score. And for Z score, how we calculate the Z score? It is basically the variable minus mean value divided by standard deviation. Because it basically, if we interchange the equation, Z into standard deviation gives you the value how much standard deviation is varied from mean, that we have discussed here. So ultimately it will give us the figure the same. So here we shall write like if there will be loss, so loss is minus 1 crore minus mean positive value rupees 2 crore divided by standard deviation is 1.6 crore. Okay, student, when we find out this value will become this. Okay, or say we take a value 1.875 positive. Now student, now our variable is 1.875. Okay, as I told you, generally we have to memorize the values of 2.33 like for corresponding to the value of 90%, 99%. Okay, 1.96. Okay, so we have considered the values like this. If you remember that when I was discussing with you the table 2.33 for the 98, sorry. Okay, 1.96 value was for the 95%. Okay, and for 99 it was 2.58 for 99%. But this value is quite different. So in that case, we cannot memorize all the values. What we have to do, we have to locate it in the our table that has been given to us in the assignment. Please remember, if this values has not been provided into your examination, you cannot, and no normal curve area table is provided to you there, so you can leave the answer there as well. You don't have to worry about the same. Now see here, there is another possibility that now you have can be provided. See here, we have to calculate the value of 1.875. Okay, so mostly same value will not be provided to you in the examination. Generally, they will provide you the equivalent value area under normal curve 1.87 or 1.88. They may give you the two values. Now here you will use the interpolation to get this value. So first of all, we locate the values of 1.87. Okay, 0.7 is there. Okay, so this will be the another one value, and this will be the another value. Okay, so area under normal curve, these two value we write it from our we find out the interpolated value. Okay, so let us solve. Here we go. Let us see how we shall calculate. Now Z score 0.9699. So the difference between these two variables is 0.01. So the corresponding difference in the area under normal curve is this. Okay, so now the corresponding area. That score will be, how it will be computed? 0.006 divided by this value, divide this value. Okay, so this value comes 0.003. Okay, so the value of Z score 1.875 shall be, it can be calculated two ways. Either we add up this value in it, either we add up this in lower value, or we deduct it from this value. Both the answer will be same. Let us see how. Okay, now other way, we can also do this way also. Z value zero point 0.9699 less value for okay student, so these two values we will see both are same. Either way it can be calculated. Okay, so now as I told you, this area is basically cumulative area. Okay, so we shall deduct it from the one to find out this area. One minus 0.09696. Okay, so it figure comes 0.0034. Okay, so it is, or we can say that one minus, sorry, it is 0.1 second. It is 0.304, say 3.04%. So there are 3.04% probability that company will be in the loss. Now, if they ask how much you are confident that the company will not be in a financial difficulty. Okay, we can say somewhere around we are 96.96%. Okay, we can say that we are confident. So it is other way around as well. So it can be both ways. Probability means 1 minus this, and confidence level is this. So 96%, it is a confidence level. Okay, student, I hope it is clear to you. Okay, student, now let us move to the last question of the assignment. This is question number 3, and it has been adopted. A slight change we have made in this question. It is from the old scheme November 2020 examination. Student, after this question, I will give the Zoom link to you so that you can enter the. I will, and we will enter into the Zoom. I will give you the Zoom link. You will enter into the class, okay, and we will solve some MCQs together, okay, so that your knowledge is further strengthened. Okay, so let us. The question is like this: on Tuesday morning, before opening our capital market, an investor, while going through his bank statement, has observed that an amount of rupees 7 lakh is lying in his bank account. This amount is available for use till Friday. Okay, so Monday, okay, Tuesday morning, and then Friday. Yani means Tuesday, Wednesday, Thursday, and Friday. There are 4 days are there. Okay. The bank requires a minimum balance of rupees 1000 all time. Investor desires to take maximum possible exposure, means they can take a position. Now, students, so far as a exposure is taken, when we will take the topic of derivative, then this term will be more clear to you, because exposure means in the derivative market, even by depositing a small amount, we can take a big exposure, because here we have to deposit the margin money, because exposure is also dependent on the margin money. So margin money concept will be clear to you there. Not for the time being, you just note it down. Exposure means how much you can take lay in the market. Okay, in the market where the value at risk should not exceed the balance lying is bank account. Okay, the value the loss should not exceed. Okay, keeping 1000 minimum. The standard deviation of the index or the same market is 1.5% per day. So time horizon is 1 day. The required confidence level is 99%. Okay, so here two things are there. Please note down. First, whenever we say that 1 day, but we have to consider it for the 4 days. So time horizon we required is a 4 days. So see, whenever the question of where is there, so we have to see what are the drivers are available. So one is our standard deviation that is available. Okay, then we are our time horizon, that is 4 days available. Okay, true. And next is our confidence level that has been given to us 99%. So there is not a problem. Let us start solving the question. amount available in bank account. Okay, this was rupees 7 lakh. Okay, so amount available which can be used for exposure in the market for 4 days.
Recording in progress.
Now next step is we shall calculate maximum loss that we can have for consider for the 1 day. Okay, for number of days. As we have done, multiply by square. Please note here we shall divide it by this way, as I told you. So now here the value will be 699 lakh divided by square root of 4. Okay, the value comes 3,49,500. Okay, now Z score at 99% level. Okay, student, you have to memorize it as I told you. So it is 2.58. Okay, so volatility in terms of so now we shall find out the standard deviation. Okay, we shall find out the standard deviation. What we do, we divide it by 2.58. But my mistake, I think I have wrongly presented this table. It is 2.33. I think there is some error in my table. Okay, I think 2.33 will be the corresponding calculation. Sorry, my mistake here. I just take back to your PPT as well. I think there is my mistake on my part. Okay, anyway. I think there is some mistake here. 99% will be this value. Okay, I think there was some mistake on my part. So because when I checked it, I again realized that, because see, if we see the table, okay, if we see the table, okay, in a table, let us go back there. 99% somewhere lying here. Okay, that I realize now. Although I told you like this 99%, so it is a 2.33. We shall value divided by 2.33. I just get it erased. Okay, now when we do this value computation, this amount comes rupees 1,50,000. So this is a standard deviation. This is the standard deviation per day. Okay. So how much amount exposure we can take? Standard deviation divided by, sorry, volatility in rupee. Yeah, just I write here. Standard deviation in rupees divided by standard deviation in percentage. Okay. So here what we do, 1,50,000 divided by 0.15. Okay, why it is 0.15? Because our standard deviation, that is 1.5. Okay, student. So this value comes 0.15. So we divided the value 1,50,000 divided by 0.15. Okay, so the maximum exposure it can take, one crore. Okay, student. So student, with this, we have come to the end of the assignment question. Now what I am doing, I am providing you the link. Okay, you can enter into the link. Okay, ask your queries, then we'll start doing some MCQs as well. Okay, the link is number, the required key number is 8351 260 1474. I'm writing here 8351 260 1474. So you can enter through the this key, then you enter into the class, then we shall discuss and carry out the further discussion. Welcome, Rohan. Welcome, Kanaya. Veda, do you have any query? Okay, no problem. Then we will start solving the. Good morning, Kanaya. Veda, good morning. Have you received the assignment?
हेलो
हेलो कन्हैया बेटा बोलिए.
या गुड मॉर्निंग सर.
गुड मॉर्निंग. हैव यू रिसीव्ड द असाइनमेंट बेटा? असाइनमेंट मिल गया था?
यस सर. यस सर.
ओके
आई
ओके
हैव.
ओके. हर्ष
सर
दुबे वेलकम. हाँ बोलिए बेटा.
सर कैन यू प्लीज शेयर द पीपीटी so that we will follow the same.
ओके आई विल सी बिकॉज मैंने पीपीटी का ना काम कहीं बाहर से करवाया है.
अच्छा.
वो कहीं कॉपीराइट का इशू ना है थोड़ा सा.
एक्चुअली सर क्या है कि सर आपने जो जिस्ट दिया है सर, तो वो फॉलो करने में इजी होगा सर.
चलो मैं कुछ करता हूँ इसका. ठीक है ना. आई विल डू
अच्छा.
समथिंग. अदरवाइज नहीं तो हमारा यूट्यूब पे लेक्चर रहते हैं, आप अपने नोट्स बना लीजिए. ठीक है ना.
एक्चुअली एक्चुअली क्या है सर कि मॉर्निंग में एंड इवनिंग में क्लास रहता है सर, फिर दिन
अच्छा
में
अच्छा.
आर्टिकलशिप वगैरह रहता है तो
हाँ
समय
हाँ
ही
नहीं
नहीं
मैं आई
मिलता.
अंडरस्टैंड, कोई बात नहीं. चलो कुछ करते हैं. ठीक है ना. कुछ
ठीक है
करते हैं. ठीक है.
सर. हाँ सर.
वेलकम हर्ष. Okay, student, now let us do one thing. We start solving some quiz questions, MCQs, so that your knowledge can also be tested and also it will make our session more interesting. So I'm sharing the MCQs. Okay, students, now let us start solving these questions. MCQs. One second. Welcome, Shalendar. Welcome, Sonlata. Okay, beta, I am start solving the. Then let us start solving the questions, quiz questions. And I think it will be better if you try at your calculator and we shall discuss the combinedly. Okay. Now one person has given the answer. Now statement without any guarantee of success, it becomes risky to either do something or omission of action choosing to do nothing is the best example of. Very good, Rohan. Your answer is correct. Whosoever doing the messaging, do messaging only to me. Your answer is correct, Rohan. Now just apply your mind. Kanaya, little bit you are away from this answer. Little bit. Just apply your mind. Technological risk is something is like when you have done something. Technical risk will take place when you have done something. Say if you installed a computer. Okay, so you have done something. The technological risk is there that there is a cyber attack. Yes, now it is correct. So, okay, student. Now here the answer is strategic risk. Reason is that counterparty risk is generally we enter into some agreement. Okay, we say, do something. So Anlata, you are also correct, beta. Your message may political risk is generally done by some other one, but we have taken the action. Technological risk, as I told you, we have installed the computer, then it is a risk. Now next question is suppose the where on a portfolio using a 1 day time horizon is rupees 100 crore. The where of the same portfolio using a 10 days horizon shall be. Now I need the answer. It is very simple. Just apply your mind. Very good. Kanaya, yes, very good. Rohan, very good. Yes, Shalendra, you are right, beta. Hmm. Okay. Yes, Harsh, you are also correct. So, see, student, as I told you, whenever we have to take that horizon 10 days or whatever it is, we always use the square root. A little bit zoom. Okay. 1 second. 1 second. 1 second. Yes. Okay. I think perfect. It will be perfectly now. I think it will be perfect now. Okay. So whenever we have to take the 10 days horizon time, so we take the square root. So square root is our prerequisite. So square root into the 10 crore because 100 crore because 100 crore is for the 1 day. Okay, so accordingly 3.1623 something into 100 crore. Okay, so we get the value of 316.23 crores approximately. So our option will be C. Okay. Now next question is the annual VAR of the portfolio is rupees 19,076. 424. The daily VAR of the same portfolio shall be approximately this. Assume 250 days and 50 weeks per year. Here time horizon is, please note, it is annual. Okay, we have to calculate for the daily means 1 day. Let me check. Yes. Rohan, your answer is correct. Kanaya, your answer is also correct. And I think there is one more answer is Kanaya, yes, your answer is right. Okay. Now let us start solving the same. Now here it is the other way around. Up till now we have done that 1 day, then we have converted into the 10 days. Now here it is reverse. Okay, here what we shall do, we shall do like this. This is annual. Okay, to convert the annual into daily, we will take a square root. Okay, so what we do like this: 1976. Okay, so value will be approximately 15.81 approximately. So the value will be 125,011. So the correct option will be A. Okay, beta, if you have any doubt or if I am committing any mistake, please discuss with me freely. Okay, don't get confused. My purpose of opening this time platform is only to that we should clear have a both way communication. Now we have to compute the weekly wear. Okay, very good. Kanaya, first you do the wrong, then you got the correct answer. Rohan, you are also correct. Shailendra ji, your correct answer. Your answer is correct. Sonlata, very good, beta. Okay, student. Now let us again we do the reverse way. Here, yes, Harsh, you are right, beta. Here we have given the weeks. So weeks are 50 weeks in a day. So here the factor will be the time will be here. We will do like this. Okay, accordingly. Okay, the option will be B. Okay, student. Now let us move to the last MCQ. Then what will be the semi-annual? Response are awaited. Yes, Rohan. It is no. Little bit you are 117. No. How you have computed it? Semi-annual means how much? Mm, let me check. Is it a response? I think it has been mixed. Sorry, sir. It will be 17. No. For one, no, beta, one not 120. That's here the confusion is. How many semi-annuals are in a one day, in a 1 year? Now here the point. See, student, I no. Sir, root की जगह fourth. No. I just solve you. There is a confusion among the students. See, semi-annual means, see, here assume 250 days in a year, 5 weeks per year, then 2 semi-annual per year. Is that correct? Okay, if we do like this, 2 per year, then how much will be there? You see the answer. Now it is clear to you or not? If you have any doubt regarding 125, I will also solve that way also. Yes, Ron. Okay, it is clear now, no? So then what will be the answer? Yes, it's a C. Okay, now student have got some doubt there, sir. There is 120. Yes, Shailendra, you are right. There is some student has got doubt, sir. There is 125 days in semi-annual. So then how we will see student, just very simple. When there this is 125 days in a year in a semi-annual. So here we shall I'm doing with different pen so that you not get confused. Now if you are asked for the semi-annual, so from daily compounding, this is a daily into square root of 125. You just compute the same. Okay, 125 into 125 square root. You compute the same, then you will get the answer of your. Okay, so the answer will be somewhat 13,97,665. It is somewhere near to this semi-annual. Okay, so 125 will be used when we are using the daily compounding, daily volatility, daily VAR. To convert the daily VAR into semi-annual, we will multiply this. Okay, student. So I hope it is clear to you all the MCQs. Please, if you have any doubt on any MCQ or any question, please, you are free. Your lines are open. You are free to ask.
Sir,
Yes.
sir, one request. Sir, please, can you please solve this question, sir?
Which question?
The
Last.
last one.
Yeah,
Yes,
I
sir.
solve it question. See,
Yeah. Thank you.
here annual word is there. When annual word is there, then annual 1 year is equal to how many semi-annual? Is that I'm right or wrong?
Yes, sir.
Yes, sir. Now say if it is, I take this otherwise. Say if I say just the semi-annual VAR of the portfolio is this amount 14,01,719. Then what will be the annual VAR of my portfolio? Will it not be like this?
Yes,
Yes,
sir.
Yeah. Am I wrong or right?
Right, sir.
Okay, Gautam ji.
yes, sir.
Okay. So what will be the answer?
1976424.
Uh, that's it only. So it is the annual.
Yes.
So here I have reversed it.
Good morning, sir.
Good morning.
Okay.
Yeah.
Sir, could you please explain the volatility once again, sir? Basically,
Volatility.
in the first question and the third question, I got
Yeah.
confused, sir. In the
No problem.
first,
No problem. No problem. See, beta. This one, na? In second question, na?
not in the NCQ, sir. In the
Okay, okay,
assignment.
okay. 1 second, I think. Here you are asking, na beta? Question number one.
Between 1 and 3, sir. First
One and
question and third
okay.
question.
Okay, here the market standard deviation 2 rupee. 1 second. It is 2% per day. Okay, volatility means standard deviation. You are confused about standard deviation, na?
Yes, sir. What you differently used in first question and third
Yes.
question.
See, your point is very right. In a third question, it has been used reverse way.
Yes, sir.
In a third question, it has been used in a reverse way. Okay, here in this question, this question, first question, we have calculated like this. We have gone by the Z score. In a last question, what we have done, if we see the solution, okay, if we go for the solution, sorry, this is a solution. In the last question, this much of loss we can bear. For the 4 days. Is that clear to you or not?
Yes, sir. Till 6,99,000 is clear, sir.
It is the where. Okay, here it is where. Because it is 1 day base.
Yes, sir.
Okay, now this term is our Z variable.
Given in the question.
Given in the question.
Yes, sir.
Okay, given in the question, or we have memorized it, whatever it is.
Oh,
Okay,
yes.
so when we have to compute the where, what we do for where we multiply Z into standard deviation.
Standard deviation.
Then we have to compute the standard deviation, then we where divided by Z.
Okay, sir.
Okay, so we have divided it by where here. And then we have got the standard deviation. Okay,
So,
but
volatility means standard deviation.
yes, volatility always means standard deviation.
Okay, sir.
Okay, this will also be used in the topic of portfolio management when we will discuss there.
Okay, sir. Okay. Got
Okay?
it.
Got it? Okay, beta.
Thank you.
My pleasure. Okay, student, with this, I
Sir.
think there are no more doubts. We come to the end of this today's session, and today's session was very interactive as well. So, student, thank you very much for your patient listening. Of course, I will also email the assignment of the forthcoming class, that is advanced capital budgeting decision assignment to you today or by tomorrow morning. I will assignment email to you so that you can have the assignment in hand to you. Otherwise, if the portal will start working, then you can download from there as well. But as a precautionary measure, I will try by today's evening. I will send you the assignment well in advance. So student, revise whatever we have discussed till now, and if you have any query, you can contact me over the telephone, and you can send me the email. I am writing my email ID here, sfm-final. For your assignment, you can also send me the request at this email ID. Okay, and this is my contact number. 0120 is a STD code, and this is 304595 is my number. Okay, student. Thank you very much once again. Yeah.
I need 1 minute.
Okay.
Sir, one thing, like June, we can't have from starting, like only last.
No, I got your point, but we are working. I
Okay.
think it will be started within 1 or 2 days, because as I told you last week, our portal is under maintenance. Okay.
Okay.
So once
And
it
sir,
will start from the very beginning, then you can
yes,
you
sir.
can tell me about my pace. There may be possible that my pace is quite on a higher
I think
side.
it's going good, sir. It's going good, sir.
Okay.
Sir, two more thing.
Yeah.
So what I seen, like the way, like everything is not in study material. Like we
Mhm.
discuss presentation, na.
Mhm.
Like study material still it's limited, na. I think we have to go beyond study material, correct?
You see, what you can do, whatever say available on ICAI website, etc. Study
Mhm.
even our assignment, we are trying to incorporate more questions. These are different from the study material.
Mhm.
Okay. So see, there is no limit on the question. You can refer question anywhere from. We don't have any. But only thing is that the source of the question should be authentic. Okay. My problem is that sometime a questions you may not find any question that any very old question from old study material, old suggested answer. Now what happens? Their perception in today's time may have changed. Circumstances like this, the perception or the answer of the question that may have changed. But if you blindly follow the old answer, then you in a problem. It will be better if you have any queries this type, you can discuss with me, no problem. But we are trying more and more different type of questions. And very one important point, let I tell you, in this May 2009 to 2026 examination, all the question bank have failed.
Mhm. Yes, sir.
Okay, only the conceptual clarity has given an edge to the students. Because if you know that you are from the your senior, May 2026, no question has been repeated from any old source.
Yes, sir.
All the questions were fresh. So we have to develop conceptual understanding. What I am saying from the very beginning, we are devoting most of the time our developing the conceptual understanding. Of course, questions part we are also taking, but our main purpose is to develop the conceptual understanding. Okay.
Even theory part also limited, na. Like the way you
No. See,
discussed.
better theory part I tell you. If
Mhm.
you go through the theory and make your own notes, then you have it. Then there will be it will help you in two ways. First, sometime some numerical part may not be clear to you. It will give clarity to you. And
Mhm.
in the theory exam, what happens? Normally, it is a common comments of the examiners. The student write very sketchy answer. The
Mhm.
keywords are missing. Okay. Even if you read this theory, I think it is more than enough. Okay, because I have it has come to our knowledge that there are some coaching center people, they are providing some very limited, very small this booklets etc. on the theory. I said avoid it. Please refer our own study material. And one more important, I will refer source of information. I will refer any one financial newspaper as per your own choice. At least one newspaper on daily basis. It will give you an insight. Okay, because I was not that much. Otherwise, there was one term associated with the where stress testing. So stress testing is a very common term. Value at risk is very common term that you will come across in the financial newspapers. So it will also enhance your knowledge. Okay, did I clear it to you?
Because sir, one more thing, questions, na, like once chapter wise we don't have. Well, we have to search in like suggested answer. This
No,
belongs to
no.
what? Like once,
Wait, if you have refer the study material.
but study material, sir, questions are very limited, na.
No,
If
see,
we
in
want.
the chapter chapter no, 2, there are not that much questions. From the chapter 3 onward, there are many questions.
Okay.
Okay. From chapter 3, there are many questions are there.
Because earlier, sir, institute was giving some, I think, recommendation like chapter wise questions were there. Now it's not there.
It used to be a practice manual earlier.
Correct.
Okay. But their questions have been merged in the study material.
Okay. ठीक है sir. Thank you, sir.
Okay. Okay, student. So thank you once again. and please prepare yourself for the examination. Anyway, wait some time. We will come out with a more question bank as well. Okay, student. Thank you very much once again, and have a nice day. Thank you.
Thank you, sir.
स्टूडेंट क्या कह रहे हैं?
Thank you, sir.
Thank you, बेटा. Thank you. Sir, can we join the every lecture using same Zoom link से तो नहीं होगा ना? No. No, but it will be different for every. It is will be separate for separate. Separate link for the separate lecture. Okay, Sanket ji. Sanket ji. Okay. Okay. Have a nice.